I've been here 15 plus years with you. My name's Darren, Farrell, for anybody that doesn't remember. Rafik is actually new, not new to the company, but new to Prairie coming out for these meetings. And we're going to talk a little bit about the 401k, a little about the economy, kind of just understand them a little bit better. Try to give you some best practices for retirement, and then talk about the economy. Okay? So, starting off regionally, what's happening? Well, Tom and I were just talking, and construction here is booming. It's not booming like this in North Dakota, but it was in 2014. Okay? So when we looked at this graph in 2014, who do you think was number one? North Dakota. I promise you, it's not anymore. Okay? So those of you that said there's not a lot of jobs being created out there, well, in 2015, 44 states created more jobs. So Washington, Oregon kind of rang the bell in that sector. Okay? While California did well on that, I think it was number 5. It's actually one of the biggest moving out states. When people move out of California, usually they end up in Oregon and Washington because we're pretty close. So we're getting a lot of people, in addition to the jobs, we're getting a lot of people come to the Northwest too. So pretty positive. Okay, guys, it's picked up another 4%, or dropped the unemployment another 4%. There's quite a bit going on. The only place that's really, the only real business sector that's weak is manufacturing. There's not a lot of manufacturing jobs being created, but we're not really a manufacturing county anyway. So what else is going on? Banfield was an extremely large vet company over in Oregon that sold a number of years to the Mars Candy family. And they moved it over here, and it's got 600 real high-paying jobs. That's going to help a lot. You guys know, because you're doing a lot of construction right now, but that waterfront project is going to get rolling, and there's a lot of other things going on to make it go pretty good. You know, the funny thing is that casino that's going on, it's really not been legally passed to get everything, all their permits and everything else like that, and they're still moving forward. I mean, they don't have all the final stuff that says that they can do the whole thing, and they're still moving forward. And the reason they're moving forward, guys, is because construction cost is going up dramatically, because there's a lot of work out there, and so they needed to lock in some of those subcontractors and general contractors to hold that bid, so they went ahead and started construction. I actually have another development that's doing the same thing. It's about 167 unit apartment and retail development, and it is literally starting. And this is really unusual, guys, but it is literally starting construction before it has its bank financing. And most of the times when you do these large projects like that, they don't go until the bank says go, and they're even starting early because they're worried about construction costs right now, because you guys are so busy. Tom even told me. Okay, what's going on nationally? Okay, unemployment, guys, is down to 4.9%. Okay, throughout history in the United States, the last 20, 30 years, 5% unemployment is supposed to be the norm. So we're falling below that right now. So everybody's saying, well, why aren't we going real hard with the economy yet? We're not. We really have not done a lot. Matter of fact, some people ask, well, Tom says, so is it going to crash? I go, no. It has to go up before it can crash down. It hasn't gone up yet. And guys, it really hasn't. We really haven't seen the economy get moving yet. I mean, we're not growing 3, 4, 5%. We're growing 1, 2, 3%. So it's actually, so to answer that question, maybe a more direct way to answer that question is we're probably more at the front end of things going forward, right, versus the back end. Okay? Okay. This now has been the 3rd year I've put the statistic up because it's super important based on what's going on. Okay, so what this tells you is that if your kids are living with you, or your parents or whatever, it's time to kick them out now, guys. They got to start buying the houses. And these millennials are the ones, especially the kids, they need to start buying houses. Because right now, this group right here, it's not like when you go out and buy a shirt or shoes or something like that, Okay, yeah, that has some impact on the economy. But when you go out and buy a $250,000 or $300,000 house, okay, that has huge impact on the economy. And we haven't had that yet. Matter of fact, this is the most, or the largest amount in the history of the country right now of pent-up demand of millennials that aren't buying houses yet. So this is in the history, because millennials are what drives the economy. We're 2/3 consumer economy. This gap right here is bigger all the way back to 1956. It's the largest. And why is that so important? Because once those guys start to buy the houses, once they start to build the houses, the economy gets rolling. Okay? And it hasn't started rolling yet. And that's a direct correlation to show you. Okay? Tom, these are the good old days, if not back then. Our houses are about 2.5 times the size that they were back in 1950, with less people in them. This technology in my pocket used to be a 6-story building. Income's quite a bit higher, even when you count in inflation versus back then. And then quality of life. Okay, you're living about 10 years longer since 1950. So I hate to break this, but these are the good old days. Okay. We usually have a Warren Buffett quote. So here's Warren Buffett's quote a couple months ago. It's an election year, and the candidates can't stop speaking about our country's problems, which of course only they can solve. That view is dead wrong. The babies born in America today are the luckiest crop in history. So I don't know. He's a reasonably good investor that's done pretty well, and that's what he's saying about our economy. And guys, last time, remember Warren's big call after 2009? He said, I'm all in on the U.S. economy, and he bought Burlington Northern Railroad, and it did pretty well after that. So he's made some pretty good calls. Okay, oil has gone up since this graph. This is super important because the other big issue in the economy, there's two big issues that you guys are seeing in the news and in the media. The first one's oil, obviously. Okay, the market's not doing well because oil prices are going down. The economy's doing poorly because oil prices are going down. And I told you this last year, and I'm going to tell you this again this year because it's a super important point. Anybody that tells you that oil going down in price is bad for the U.S. economy, they're not telling you the truth. Okay? You have a lot more money in your pocket. It's like a huge raise, which means you're going to do two things. You're going to save that money, and you're going to spend that money. So it's going to make your net worth better, and it's going to make you get the economy going. So low oil prices, well, I think now they're back up around $45 a barrel. At this time, it got down to 31. So the point that they're making is it's pretty dirt cheap. These are Home Depot prices about a month and a half ago, guys. Okay? Okay, so guys, what makes the stock market go up? It's real simple. This correlation is 95%, which means it almost always is right. But when companies make more money, real simple, they become more valuable. Okay, these are all great companies up on the board, all great companies your mutual funds invest in some way, shape, or form. And when the market goes up in value, it's because profits go up. And like we said, I think most of these companies are going to start doing better. I mean, a great example right now is like Tom said, our company. Look how busy we are right now. Okay? So things are going. Okay, what's going on around the world? This was I like this graph quite a bit. Because everybody talks about the violence that goes on around the world. And we see it every day on YouTube and CNN and all these places. But the point this graph makes is that we're actually in the most peaceful time we've ever been in the history of the world. We just have media tell us that it's not. Okay. But I thought this was pretty amazing. That I read in my textbooks that Genghis Khan was a bad guy. I didn't know he was that bad. He wiped out 11.1 of the world's population from 1206 to 2027. So nobody's doing that now. It's pretty peaceful now on a relative basis. So the world's not as violent as they're telling us on YouTube. Okay, this is also a great graph because it gives you some perspective, because this is the big discussion. You know, China's going to pass our economy, world's coming to an end. And now, remember, in 2009, China was going to take us over and pass us in the economy. Now they're going to go out of business, and so now that's the biggest problem. So you can't have both sides. It's one or the other. You've got to pick either it's going down or going up. But I don't think it's going down, and we'll talk about that in a second. I think it's going to do pretty well. And we also want it to do well, guys. It's not good. It's not good if China blows up on us. Okay? And it won't. I strongly don't think it will, since I'm being recorded now. But anyway, this is a big difference. Is that, well, gosh, Darren, in 1960, we were 40% of the world's economy. I mean, we're 300 million people out of 5.3 or 4 billion people, and we're 40% of the world's economy in 1960. Okay, but we shrank down to only 26% in 1990. And my question is, did we shrink? No. We're 26% of 22 trillion versus 40% of 1. Okay, so the same thing in 2015, guys. We are 300 million people, 319 million to be exact, on 5.4 billion world population. And we produce 22%. Okay, so I don't want to brag about the U.S., but I do want to tell you, when people tell you that it's horrible here and it's a bad place, we do really well relative to everybody else. Really well. Okay? Okay, back to China. Okay, so why is China not going out of business? First, I'm going to give you the amazing statistic. I told Bill this earlier, and he was surprised by it. But from 1900 to 2000, we poured 4.5 gigatons, which I don't know what that means either, but it's a lot, of concrete in the United States. So from 1900 to 2000, 100 years, we've poured 4.5 gigatons of concrete. Okay? From 2011 to 2013, 3 years, China poured 6.6 gigatons of concrete. In 3 years, they poured more than we did in 100. So what does that tell you? It tells me that commodity prices are way down now because of that, because they're not quite building as fast now and what's going on with China. But it also tells me they did a fantastic job of what we did when Eisenhower was here. Eisenhower built up our infrastructure. He built our highways. He got the rivers working. He got the railroads working. That's what China's just done. So while China now is going to become a consumer-driven economy, and you're saying, well, Dan, how do you know they're going to become a consumer? We're 2/3 consumer-driven. They're going to become a consumer-driven economy. And the reason I know that is we have 86 million millennials that are going to drive our economy. They have 415 million. And 107 are college educated, which tells me that they're going to have the economy in China moving similar to ours with a few more people. So China's not going away. But I think that's good, not bad. Okay, so I hit China, I hit oil. I guess I could talk about interest rates and Federal Reserve, but what else are you guys hearing that you're wondering about or have questions about? Anybody have anything they want to touch on before I jump to the next graph? Okay, I'm going to talk briefly about our funds and then I'll come back to them. But the first thing I'm going to say is small cap world in the growth sector is probably our most aggressive fund in the portfolio, and you shouldn't put 100% in there. That's a lot of risk. But the same thing is this money market down here is our most conservative one. Okay, it's like a money market at a bank, except it's not FDIC insured. Okay, I also wouldn't put 100% there because that's too risky. You want to spread it out in this sector, and I'm just going to talk briefly before Rafiq jumps up. But remember, the growth funds take the highest risk in the group. The growth and income funds are probably where most of us should be, especially if we have over 5 years before we're going to retire. Okay? If you want to be conservative, the equity income balance sector is probably a good spot to be in. And then the bonds, unless you have a year or two to retirement or a year or two before you're going to take out those funds, I probably don't want you to have a whole lot in this sector right here in bonds. And money market, I don't think it makes sense. It's not paying anything. So anyway, that's a quick, we'll come back to that, but I'm going to turn it over to Rafiq to tell you a little more about planning savings.
Thank you. Hello, everybody. My name is Mike. I'm a certified financial planner that works with Darren. If you ever have any questions on your 401k, please feel free to give me a call. What we're talking about here, and Darren was discussing the broad economy, what I'd like to talk about now is your 401k plan and just how you relate to your savings account and what's available to you. Just starting with the basics, we have the plan year. In your case, starts at October 1st through September 30th. And that's important later when it comes into how long you have to work here for you to be eligible for the plan. You need to work here for at least a year to start getting the profit sharing contributions. That's when there's profits. The target is to save 4% of your salary on your behalf into this retirement account for you. But from day one, when you become eligible, you can start saving your own money into this plan. You have to be at least 19 years of age to be able to start saving into this plan. And you become available to start saving into it the month following the year or the moment of your eligibility. Once you're starting to save, if you decide, hey, I'd like to up my savings amount, or I'd like to reduce the amount that I'm saving, you can actually change that quarterly. So it's not a permanent set, like in some cases in the world. You can save up to $18,000 per year into your 401k. If you're over 50, you can save an additional $6,000 for a total of $24,000. Again, if there's profits, the goal is to save an additional 4% on your behalf each year into the plan. So if you're saving 10% of your income, the goal would be that 14% of your income is going into this account. If you have previous work that you've got retirement accounts as well, and you don't want statements coming from different plans, you can consolidate those accounts into this 401k. Just to make it easy on you so that you're only tracking one investment pool as opposed to many. And earlier I had mentioned that you can save your monies immediately once you're over 19 and are deferring. And you're 100% vested in the dollars that you save into this plan. And if you roll money into this plan, you're 100% vested in those dollars. What does vesting mean? That means that it's your money. You see, if they make a profit-sharing contribution, you're doing that to help reward people that are long-term employees. And so you become fully vested in those profit-sharing contributions after you've worked here for a complete 6 years. The earnings allocation is based on your investment. So you're responsible for investing your portfolio. The company's not going to do that for you. And as Darren showed you, there's a number of different investments available within the plan so that if you're close to retirement, there's something that's appropriate for you. And if you're just starting out, there are investments appropriate for you as well. As I mentioned, here's the vesting schedule. Of course, we're hoping everybody works here for longer than 6 years, but in this example, if somebody worked here for 3 years, they would be 40% vested in their 401k profit sharing contributions from the employer. And the next question is, okay, well, that's the tool, that's how I can use it. Well, how can I increase my chances of success in retirement? And the first point is there's a lot of competing goals that you have in your life. These are just some ideas of throughout your life cycle, things that are drawing your dollars away from saving for your retirement. But I want to stress that the sooner you start saving for your retirement, the easier it is. The longer you have for the power of compound interest to grow your monies. And so because of that, I highly recommend starting sooner than later. For every one of you, your individual results will vary, but there are some rules of thumb that we can say, hey, it's at least better if you've heard these things so that you have an idea as to how to gauge whether or not you're on track or not. First and foremost, once you start taking distributions from your retirement account, you're going to want to only distribute about 4.5% of your account. So on $100,000, that's about $4,500 a year. And that's because that's the amount you can take out adjusted for inflation for the duration of your retirement, historically speaking. If you take out more than that, there's chances that it can survive, but the worst thing would be to have you spend all your money and still be kicking, right? And so we don't want to have you run out of money in retirement, and that's why you don't want to spend 50% of your retirement account in your first year out of work. The other thing is you're going to generate almost half of your income from your savings when you're in retirement. With that said, you want to try and accumulate roughly about 10 times the amount of your yearly earnings into your retirement account. Again, just as a rule of thumb, that's a target. That's something you want to be shooting for. And then finally, the best way to get there is to save about 15% of your income each year. If for no other reason, that means that gets you used to saving or spending about 85% of what you're making. And if you're spending less, it's easier for you to make that up once you're in retirement. If you're wondering what that means, here are just some ideas. If you're making $40,000 a year, saving 15% of your income would be roughly $500 per month. If you're making $80,000 per year, that would be about $1,000 per month that you're saving away. And what I'm showing you here is to say, again, the later you retire, the more you can take out from your portfolio. The earlier you retire, the more you have to save, because you've got a much longer time in retirement, right? If you're trying to retire at 62, it's not uncommon for people to live into their 90s, even 100, without meaning you have almost as long in retirement as you were working, right? So you need to save more aggressively in your working years. What this is showing you is that if you are 70 years old, or if you're going to retire at age 70, then you need to save roughly about 11% of your income per year. Again, as a rule of thumb, as a target. Whereas if you're trying to retire at 62, you want to save about a quarter of your income per year, right? So the later you're planning on retiring, the less you generally need to save, the less of a factor you need to save. Again, at 70, it says you need about 8 times your earnings to be able to retire comfortably there. Whereas at 62, you need about 14 times your earnings. Now, here's a bunch of disclosures that go along with that, because the things that I can't tell is I don't know how long you're going to live. I don't know how much you're saving on your earnings. I don't know what the rate of return is you're going to have on your savings. So what we say is, if somebody asks me, how much do I have to save for retirement, because I can't control so many of those factors, really the right answer is just as much as you can. Because you want to have a little bit of a buffer for in case you earn slightly less, or if you live slightly longer. Living longer is generally a good thing, but when you're trying to save money for your retirement, it makes it harder because it means your money has to last even longer. And so, again, there's a lot of different variables that go into this. So please lean on us as a resource to you. We're here to help. We're here to help you pick your investments. We're here to help talk through what's a reasonable amount of savings for your personal situation. And so, with that, I just want to ask, does anybody have any questions on those factors or anything regarding your retirement accounts?
It's a nice summer day. I'll jump up there and we'll finish.
All right, sounds good.
Put me on that. Can you put the button back up there? Okay, this is once again talking about the funds that are available to us up here. And guys, I want us to pay attention to the lifetime returns on these funds. And I know that up there they might be hard to see, but they're also in the booklets that you're able to look at. But guys, I want to point out, these funds have been around a long time. 1934, 1952. Lifetime return, 11.78. Lifetime return, 12.03. And I'm not telling you those are the returns that you're going to get going forward next year or the year after. But what I think is a reasonable expectation is to probably expect a return on these funds that you'll see in your booklets somewhere between their lifetime and the 10-year for the next 10 years. Okay? I think these 10-year numbers are low. The reason they're low is because the world blew up in 2008, and that's reflecting it from these numbers. So let's go back to an old rule that I taught you that I think is critical to helping you understand where you need to invest the funds. Okay, so let's do it real simple and say, everybody remember that old rule of 72 we talked about? That was taking the rate of return and divided it into 72, and it basically told you how long it took your money to double. So let's talk about that real quick. So if I earn 1% on my portfolio, Tom, how long does it take me to double my money?
Yeah. 72 years.
They said there wouldn't be math.
Sorry.
It does. It takes 72 years for you to double your money. Okay. I don't think many of us have that much time. Okay. Where if you go to the equity funds, which a lot of them earn over 10%, okay, rule of 72 says I divide that into 72, it only takes me 7.2 years. Okay. So that's my point I made earlier, is there's a lot of risk too in trying to be too conservative in the portfolio. Okay. So spread it around a little bit. For those of you that are young and have a lot of time, you really need to, again, hang out in the growth funds and the growth and income funds. For those that are over 50 and are conservative, you need to have maybe 25, 30% in this sector. Okay? If you're not conservative, you don't have to have it. But if you're conservative, you probably should. Okay? And for those that are real conservative, maybe 40 or 50% in this area. Okay? For the most part, you're probably going to do well in the growth and income sector. That is the large companies, a lot of cash on the balance sheet, good income, good financial. If I had to say the sectors now of which funds, where I kind of said were the ones I like at this time, I think that Euro-Pacific, because Europe's doing so poorly, is probably on sale a little bit right now. I really like the growth and income sector, guys. I like most of the funds in there. If I could only pick one, I don't know that I'd want to. I think I'd probably pick international growth and income or fundamental investors. And the way I'd make that decision is if you believe that Europe's on sale and the foreign stuff's on sale, then I'd probably go international growth and income. And if you say, hey, the U.S. is the one that's doing well and it's going to continue to do well, then I'd probably pick fundamental investors. Okay? Equity income balance, I like both of those right now. Balance fund and capital income builder. I like them both. If I could only pick one, I'd probably pick capital income builder. Okay? All right. I know it's nice summer day already. So, any questions, any concerns? Thanks, guys, for listening. Appreciate it. Appreciate the business.